We go ahead and get started. My name is Jonathan Parker. I'm the Robert Merton Professor of Finance here at the Sloan School and a co-director of the Golub Center for Finance and Policy here at MIT. It's my pleasure today to introduce Dan Tarullo, who we are honored to have him visiting the MIT Golub Center and joining us in our efforts to better affect economic and financial policy here in the United States and around the world. Most recently, Dan served as a member of the Board of Governors of the Federal Reserve System, starting that position in early 2009. Appointed to the Fed board by President Obama, he served as chairman of the board's Committee on Supervision and Regulation and was chairman of the Financial Stability Board's Standing Committee on Supervision and Regulatory Cooperation. So he essentially stepped into the center of the financial crisis during its darkest days and has overseen and helped design the regulatory and policy actions that ended the crisis, as well as the major reforms of regulatory and policy treatment of the financial sector since then, with the aim of making sure that such a financial crisis does not happen again. In the press release announcing his resignation, Chair Janet Yellen stated, Dan led the Fed's work to craft a new framework for ensuring the safety and soundness of our financial system following the financial crisis and made invaluable contributions across the entire range of the Fed's responsibilities. Prior to saving the US and global financial order, Dan was an academic, a professor of law at Georgetown University, where he taught international financial regulation, international law, and banking law. He also held senior positions in the Clinton administration and served on the staff of the late Massachusetts Senator, Senator Edward Kennedy. Please join me in welcoming Dan Tarullo. What I'm hoping we can do today is I think I'll start by asking a few questions, sort of to get the ball rolling, and then we'll open the floor to see if we have questions from the floor, and we can have a good discussion about some of the important events of the past decade plus. So my first question, you've been Fed governor during probably the most revolutionary policy response and restructuring of the financial sector part of the economy, at least of my lifetime. And you stepped into the board in January of 2009. What I remember is sort of the financial crisis darkest days. Shortly after that, I took a leave from academia to work at the Office of Financial Stability in the US Treasury, and I remember the sort of feeling of shock and awe one had in those days when the unprecedented kept happening from the financial side of the economy, and then from the policy side, the unprecedented kept happening. The US owned the largest banks, insurance companies, auto companies, not quite owned all of them, but 80% of Citibank, for example, and AIG. We were an economy that was unrecognizable relative to where we'd been a decade before. And then in the post-crisis system, we've really rewritten a lot of the way that financial sector regulation is done with an eye towards systemic safety. And so my question is sort of, you've been through an amazing down and up and reformations, if you will, of the way we do things. Can you pick a day, a time, an event, a period that strikes you as sort of especially memorable and interesting or full of lessons for those of us on the outside
So
you can regale us with?
Yeah, there are probably a couple, Jonathan. It's not, the Fed and central banking in general tends not to be exciting in the way that, my White House job was exciting. And, there were no first trips on Air Force One. There was no private tour of the Imperial Palace in Tokyo. There was none of that sort of stuff. Decisions at the Fed, even in very stressed periods, tend to happen in an incremental way, albeit sometimes a very sped up incremental way. But there were anxiety-provoking moments of various sorts. And I'll mention a couple of them, and then one sort of moment where I could feel the regulatory reform momentum really picking up steam. So first off, I should say in some respects, the thing that stands out for me most was, as a dramatic moment, was not when I was actually at the Fed. I had been announced by then President-elect Obama in mid-December, and I was back at the transition headquarters of the, they have a place where the elected president and the president's team plan for transition. At that point, it was an old SEC building on 6th Street. And I got back there, and I was actually cleaning out my office because since I had now been named to the Fed, I thought, yeah, probably shouldn't be around the administration's transition offices anymore. And several people came in and said, can we have a talk about the financial system, which is about all any of us had been talking about. And I'm not going to mention who this guy is because he's pretty well known. Many of you would recognize his name. But we sat down, and he looked at me, and he said, so we're thinking pretty seriously about maybe having to nationalize the whole banking system. And, I thought grasped the magnitude of the crisis. Like many people, I had that moment of insight in early August of 2007 when BNP's problems became apparent with asset-backed commercial paper. But somehow having somebody who was going to be in the administration say to me, we need to think about nationalizing the entire, not 80% of AIG, not some assistance for a few banks, but the entire banking system, sort of brought home, this was several steps beyond what I had experienced in the White House during the Asia financial crisis. a different but not, in some respects, unrelated moment came not very long after I got to the Fed, when we were beginning to do the stress test that we did right in the middle of the crisis, beginning in February of 2009. Something was kind of created on the fly, been talked about a lot as a potential supervisory tool. Had never been done, certainly in this way. And of course, in order to do a stress test, you actually have to have information on the portfolios, revenue streams, and the like of the banks which you're stressing. And so our supervisory guys got together the template, the electronic template for all the information that we were seeking to get, sent it out, and a few of the institutions, this was to about the 30 largest regulated financial institutions in the country. A few of them, within 24 hours, whole thing was filled out, sent back electronically, turned out over the course of the succeeding weeks to be pretty good, pretty accurate. Most of them took several days. The information was incomplete. And I regret to say, a non-trivial number of these very large banks, after a week, we had to get back to them and say, where is that information? And they said, well, we sent out requests to everybody, and it's coming in hard copy, right? There was no capacity of these firms, these very large banks with hundreds of billions of dollars in assets, and in one case, which I won't mention, well over $1 trillion in assets, incapable of aggregating their basic information and for their own risk purposes, much less to give it to us for stress purposes. In one case, this institution that I referred to, after several weeks, still could not figure out its total exposure to its major counterparties because all the risk management systems were siloed within the different affiliates of the institution. Now, what that came home to me, forget about the vaunted efficiency of the private sector at this point. The Fed had better information on some of these banks than the banks had on themselves because the stuff had been aggregated by the New York Fed. Second, now I could understand better how these guys had gotten themselves into such trouble if they didn't even know what their risks were. But third, I then began to see some of the outlines of the kind of supervisory system we were going to need if we were going to have a financial stability mandate in addition to a conventional microprudential supervisory mandate. So that was a revelatory period of seeing all of that. So then let me mention something a little bit more on the upside, which is now a couple of years later. We had been pushing very hard to have a set of progressively more stringent or higher capital surcharges to be applied to global systemically important institutions, banks, on top of the capital requirements, the revised capital requirements, which would apply to all internationally active banks, and in the US and the UK and the EU to all banks. By we, I mean the United States, and specifically the Federal Reserve Board, and specifically me. Towards the end of that initial Basel III negotiation, which is where the minimum amounts were raised and the emphasis went to common equity as opposed to this sort of somewhat dodgy forms of capital that had been recognized beforehand. I put that out in a meeting of the governors and heads of supervision of the members of the Basel Committee. And there was at best a lukewarm response. A couple of countries said, that's a great idea as long as it's not put on our banks. A number of jurisdictions said the problems were all in the United States, so you should do that, but the surcharges shouldn't apply to us. And some other jurisdictions kind of just, metaphorically cast their eyes down to the table and tried not to make eye contact with anybody so as not to talk about this. There ensued a period of about a year and a quarter where the Financial Stability Board Steering Committee, which at that point only had about 18 people on it, it was a pretty small group, and we were meeting probably bi-monthly, either in Basel or someplace else. They were real discussions, real conversations. The FSB today is so big that it's become more like you put your tent card up and someone says something, you kind of go down the line. Those are real discussions. And you had quite a remarkable group of people at the time. Governor Zhou, the governor of the Central Bank of China, Mario Draghi, who at that time was still the governor of the Bank of Italy, but was soon to be president of the ECB. Mark Carney, who was then governor of the Bank of Canada, now governor of the Bank of England. Christian Noyer, the recent retired brilliant governor of the Banque de France. It was really quite, and we were lucky that it was quite an extraordinary group of people. But there were all these sort of going in positions, and I began to despair of getting convergence around the proposition that we needed for the truly systemically important institutions a more stringent, not just capital requirement, but set of requirements more generally. And there was this moment, it was actually, I remember it because the meeting was at the Banque de France in one of their rooms that seemed to, probably had enough gold to buy half of Paris in it. I mean, everything was gold paint and gold this and gold that. The acoustics stunk, but it was a really beautiful room. And I making my arguments, and we had a few allies from some of the other countries, but wasn't great. And I don't think he'd mind me saying this. A guy named Axel Weber, who at that time was the president of the Bundesbank, and now is the chair of UBS, actually. The institutional position of Germany and the German regulator and others had not been very enthusiastic about this proposal. And Axel had listened for all these meetings and had asked questions, sort of gone back and forth with us. And there was a moment at which he said, and this was in that room, he said, we need to do something here. Now, it's a very simple declarative sentence, may not mean much of it, but for him to say it at that time, and given his position, given what he'd gone through, it was kind of this watershed moment. And, it's not exciting in the sense of, lots of people and all of a sudden you say this. It was more significant in the way that there are significant moments in a Henry James or a Virginia Woolf novel where a seemingly mundane line reveals just an enormous amount about a character, or in this circumstance, reveals a lot about Axel and his integrity, but also revealed that there was going to be a real reorientation of the international regulatory system. So that's probably more than you were asking for,
No, that's great.
but
Thank you.
that sort of was the, that moment really does stand out in a lot of ways, and probably not just because I'm a Virginia Woolf aficionado, although I think that's probably part of it.
Let me ask one more question. So as you step down from the Fed, or having stepped down from the Fed, obviously one can't sort of see everything to fruition. Is there a sense, or is there an opening, I guess an undone piece of financial regulation moving forward, something that you kind of wish had been accomplished over this time period? Or alternatively, something that actually happened that you just wished you could kind of roll, this is a piece that maybe doesn't fit with the rest of it the way the world's now ended up?
Oh yeah, probably both of those, Jonathan, I think. So there's a fairly well specified agenda that still needs to be finally completed in the capital and liquidity area and the modification of the stress tests. That stuff is all out in my speeches, Janet Yellen's speeches. I'm hopeful, and I actually expect that it will get implemented over the course of the next 6 to 12 months.
And you mean figuring out the amounts, where these things how binding, what should be under each label?
Oh, no, it's actually, getting the net stable funding ratio, that longer-term liquidity regulation in final form, making these changes in the stress tests so that the surcharge the surcharge I was referring to, that's applicable to the biggest banks, gets effectively incorporated into the post-stress expectations, by the way, while also bringing down somewhat the capital requirements for regional banks. So it's those sorts of things. I would say the area where we haven't yet, I think, really figured out a mechanism, an adequate mechanism going forward, is for all the activities outside of the prudentially regulated sector. I mean, this is sometimes referred to as shadow banking, or if you want a less normatively charged term, market-based finance. That you can imagine that this sort of stuff just gets generated as a regular matter within the financial system anyway. B, to the extent that large prudentially regulated institutions now have a more rigorous set of regulatory expectations, the opportunities for, again, this is a charged term, arbitrage, but let me just say I'm meaning it neutrally, by unregulated entities obviously pick up. And so if one anticipates that you could have over the course of the next several years, the rapid, and it's usually rapid, growth of some sort of intermediating mechanism or instrument which combined a good bit of debt and a good bit of short-term funding, then you may have the stuff of a potentially dangerous situation. We do not have either a set of generally applicable legal standards to say this sort of thing is prohibited or regulated or okay. It's not for want of trying. It's just been hard to do the definition. Or B, an effective and empowered process within the U.S. government that could assess these things as they came along and then say, all right, this is fine. We don't need to do anything here, or keep an eye on it, or gee, maybe we need margining requirements or something else to be put in place there. There is no plenary authority to regulate the financial sector in the U.S. government. The Fed has some limited authority outside of the prudentially regulated banks. The SEC has some authorities, the reach of which are probably a little uncertain. Clearly, if it's to protect investors, there's all kinds of stuff they can do. The Dodd-Frank Act means that they have more of a financial stability mandate, but how far that extends, I think, and how far they want to go institutionally are open questions. The Financial Stability Oversight Council, this thing created by Dodd-Frank with people from the different agencies, actually has very few powers, and certainly wouldn't have the power to say, for example, we want minimum down payments on every mortgage in the United States, no matter who writes it. Of course, Fannie and Freddie could do that, but there's no U.S. government agency that could do it. So I think the absence of that kind of either legal definition or legal process is a non-trivial bit of unfinished business from the post-crisis period. It's not as though I think there are some of these dangers lurking out there right at this moment, but over time they'll build up. In terms of what was done that maybe, there was probably too much complexity in some of what we tried to do. I mean, the Volcker Rule is the best example of that. Paul Volcker had this very simple idea. If you're affiliated with an insured depository institution, you shouldn't be doing proprietary trading. Once the 5 regulatory agencies got a hold of it, it became this massive exercise to try to create a whole raft of metrics for each trading desk with each different kind of asset, and then say, could we infer the intent of the traders based on these objective indicia? And the answer is, yeah, but boy, you better have, half the MBAs coming out of the Sloan School this year working on it. And that's just at the Fed. Forget about the banks that actually have to give the information. So I think there and in a number of other areas, the complexity of some of the regulations is probably going to limit their efficacy and may well create compliance costs and supervisory costs that are disproportionate to the benefits that you're getting. Now, I should mention something, though, as to why there's some of this. Again, I think if you ask Paul Volcker, I don't want to speak for him, but I bet you if you asked him, he'd say something like, well, just have the Fed go in and in their regular examination of the big banks, take a look at what they're doing, and if somebody's doing something that looks like prop trading, say, stop doing that, or do it this way. In the post-crisis period, there was a lot of anger at the banks, but there was also anger at the regulators and the supervisors. And so, to some degree, the detail in the law and the expectation of a lot of detail in the regulations is a manifestation of a lack of complete trust in the supervisors to just sort of do it sensibly. And some of you may know that a similar, although less extensive phenomenon occurred in the aftermath of the savings and loan crisis in the 1980s. After that, when the Congress enacted amendments to the banking laws, which included this sort of prompt corrective action structure to earlier intervention in banks that might be troubled. A lot of that was intended to provide more specific oversight of and responsibilities for the regulators, the supervisors, who had been regarded as having engaged in regulatory forbearance and allowing all these oil patch banks to continue to pay out 15% on the CDs while making loans that were 12 or something. The stuff that had been going on for a while in this search for redemption. So I think there's a reason for some of this, but it begins to kind of bog down after a while. And some rationalization of that, I think, would be helpful. And I think it would actually be helpful to, in some areas, not capital, not some of the other, but in some areas, perhaps like incentive comp and the Volcker Rule, to let the regulators have some more discretion, and let's have it more of a supervisory rather than strictly regulatory format. And that might, over time, either suggest to us how to write a reg that does it in a more objectified fashion, or tell us, hey, this is working pretty well, or no, it's not really working, so let's go back to the drawing board.
Yeah, there's a, why don't we open it to questions? Do you guys want to raise your hand? We'll come around with a microphone.
Thanks. So my question is, so there's currently a couple open positions on the Board of Governors. Are you at all, yeah, 3 open positions. Are you at all concerned about the people that Trump might appoint to fill those positions?
As a financial regulatory matter or monetary policy matter?
Well, just thinking about who he's appointed to head other agencies. He's appointed someone to the EPA who hates the EPA. He's appointed someone to lead the Department of Energy who promised to get rid of that when he campaigned for president. So are you concerned about like these end the Fed people being appointed to lead the Fed?
Well, so, I mean, my observation and reading of history has been that virtually every administration, once they're in administration, decides they like accommodative monetary policy. You know, whatever the priors were coming in, they kind of like accommodative monetary policy.
It's kind of like they hate deficits before they show up.
Yeah.
And then,
Yeah.
and then,
There's some of that, but I think the monetary policy is even more consistent than that. And of course, that's one of the reasons why people think you need independent central banks. But what it suggests to me is that this administration, like past administrations, is probably not looking for radical changes in the way that monetary policy is conducted. There may be changes at the margin, but again, I don't think there can be radical. I wouldn't anticipate there'd be radical changes. The Fed itself, institutionally, you know, it has its virtues and its faults, like any organization. One of the virtues, to date at least, has been that at least within the Board of Governors itself, there's a pretty strong tradition and culture of working stuff through in a very analytically grounded fashion, trying to take account of different views and come up with a consensus policy. And, you know, it's not as though culture and tradition can't be changed, but I think it does have an effect. And when added to what I mentioned a moment ago, which is I think the incentive of virtually every administration to have people who are at least open to an accommodative monetary policy, I think that, you know, my expectation that the best monetary policy for us right now is going to continue to be a gradual, cautious increase in rates over time where action is taken, you kind of see what the effects are and go forward. I don't see any particular reason why that would change over the next couple of years with the appointments that might be made. On financial regulation, I mean, there's going to be a shift. I'm honestly not sure yet what the shift is going to be. I think there are many cross currents that the administration feels itself, you know, in the middle of. I mean, it's a little bit like, you know, sometimes right at the mouth of the Boston Harbor, where you've got the tides sort of semi-coming in and they kind of go against, right where the Logan landing strip, you know, they kind of go against each other. I think that's sort of the way they are feeling right now because they've got multiple constituencies with multiple interests. I can imagine some directions for changes to financial regulation would be deeply troubling, you know, trying to reduce the capital requirements of the biggest banks, I would find deeply troubling. There are others that I might not agree with, but I wouldn't say struck to the core of the important post-crisis reforms. And there are still others that I might say, well, good, you know, I've been yapping about them for a while. We couldn't accomplish them, and they can. So you know, you have a tendency always to be concerned for who's going to do your job. But, you know, it's kind of life, right? I mean, you do your job, you move on, and you can't get too committed to the proposition that somehow everything that you did was optimal, and whatever happens later isn't. So of course I'm concerned, but I think it's premature for people to have come to the conclusion that this is just going to be, a big problem. Because honestly, I think the more likely outcome in the end is somewhere between my second and third categories. If it's not, then I and others, I think will speak up about that. And this is one of those areas where liberals and conservatives tend actually to come together. More moral hazard, big banks. That I never had gut criticism in front of the Senate Banking Committee when I went and testified about some increase we were making in the capital requirements for the biggest banks. Dems, Republicans, no criticism. And a bunch of them on both sides would sort of speak up and say, good, that's what you should be doing. So I hope that, what did I call it the other day, the bi-ideological, if not bipartisan, position will prevail.
Similar to capital requirements, a question about ring fencing. After the financial crisis, the UK was the first to kind of implement some sort of ring fencing regime. And in discussions with foreign banks, there's thoughts of, is there a race to a lowest common denominator, or the countries racing to get their ring fencing regimes up first? Can you kind of give feedback on your thoughts in your global discussions with the FSB, for example, on how ring fencing came to be, and where do you think these global balance sheets will look like 5 to 10 years down the road when it comes to capital and liquidity?
Well, so in the European Union, every financial institution from a foreign jurisdiction has to be separately chartered, incorporated, with meeting local capital and liquidity requirements. I don't regard that as ring fencing myself. It's sort of again, one of those normatively charged terms. Bankers point their fingers at you and say, you're ring fencing, you're ring fencing. I think, that, so what we did was basically to put in place a parallel set of requirements. We did it because, just come out the fact. During the financial crisis, a highly disproportionate use of the discount window at the Fed was for the benefit of foreign banks in the United States. Highly disproportionate. They had funding models that were unsustainable. They were dollar mining in the U.S., raising the dollars here, lending them abroad, and then exchange rates shift, and there's a problem. The capital held by at least a couple of those banks was around zero here, and not the bank you used to work for. Don't worry about that. We're not talking about them. So for us, both because we thought the Europeans sort of had a sensible approach, and because, unlike, except for London, there's nowhere in the world that has so many foreign broker-dealers who are, in our case, 5 of the 10 largest broker-dealers were foreign banks in the U.S. with no prudential capital requirements. So what we really did was to say, okay, let's go down the road that the EU has gone down, have that requirement to meet local capital and liquidity standards. But, and this has been important to this point, we haven't required that the surcharges, capital surcharges, apply to the local operations. That's just global. Nor has, I'm going to once again stop myself from using the first person plural, nor has the Federal Reserve to this point restricted the operations of branches of foreign banks in the U.S. But I think what the Fed will do is to watch, and has been watching, what the foreign banks are doing as they instead of increasing capital in their intermediate holding companies in the US, they've moved a bunch of activities into their branches. And if that turns out just to be a way to evade the capital and liquidity requirements, I think the Fed's going to need to make a response. And similarly, if it turns out that the Fed can't have confidence, or the US banking agencies cannot have confidence in the reported global capital level, consolidated capital levels of foreign banks because of lack of transparency, mistrust of internal models and the like, then they're going to have to think more about the branches in particular, because obviously those are relying on the consolidated capital from abroad. If there were two things that sort of emerged from the discussions internationally, one of them would be the position of many jurisdictions that when we do it, it's prudential, when you do it, it's ring fencing. But the second, more reasonable position, which I think was, for the present, let's try to keep our local requirements for the foreign banks, the generally applicable ones, and not the special surchargey kinds of ones. Those will apply at the global level, and so the extra liquidity or capital should be available to deploy globally as is efficient and needed. And that sort of has held to this point, but that is premised on trust in the consolidated regulatory and supervisory positions of the home banks, of the big banks in the US or the UK or Singapore or wherever. And that's why the discussions still going on in Basel are important, because it's not just saying, have we kind of formally agreed to this, but are these things effective or not?
Great.
This guy.
No, go ahead. After you.
He's got the
Just
mic.
next.
Sure. Okay. So my question's about proposed regulatory reforms. So I know one thing that's been discussed at least a little bit is changing the operational risk requirements for banks. And, on one side says it's important to disincentivize recidivism. The other side says that locks up a lot of bank capital. I have a sense of what your take is on the issue, but if you could provide some clarity on what you think the optimal policy moving forward would be.
Yeah,
would
so
be nice.
you got to distinguish there between the amount of capital being held by banks and in general, and what's the best way to deal with the potential losses from operational risk. So some of the banks are now pushing to get rid of or cut back on operational risk just because they want their capital requirements reduced. But there are other really quite thoughtful takes on operational risk coming from current or former bankers. In fact, Peter Sands, who used to be the CEO of Standard Chartered, who's actually spending some time at the Kennedy School. He and a couple of others have a nice paper that they put out in which they try to distance themselves from the question of how much is enough and instead get to the methodology of how you should do it, which I think is quite reasonable. Here's the basic issue with methodology. So the the way that the Basel Committee has been talking about reforming, first off, current methods for op risk, nobody thinks they're satisfactory. The Basel proposals right now put a lot of weight on operational risk losses which you have endured in the last 10 years, I think. Operational risk, by the way, for those who don't, is everything from legal liability, fines, to rogue traders, to fraud, to your systems breaking down, to a hurricane sweeping you away. It's basically anything that isn't credit risk or market risk is op risk. Now, you can tell just by that, this stuff is not as regularly predictable as, losses from your auto lending. So it's always going to be methodologically challenging. And I think what the Basel Committee has said basically is the past performance of the firm is a reasonable indicator of its future problems. And essentially what they've said is if you had, a big MBS settlement and your computers were down for a week and so you lost a lot of money and stuff, that just shows that you've got a lot of operational risk. And so on a kind of rolling basis for 10 years, your op risk capital charges will be largely based on that experience. And you have to be better for a while before those op risk things go down. The counter of that, and Peter makes this point, I think, very effectively, is to say, yikes, what happens to incentives to change at that point? If you say, okay, we're not going to do auto lending anymore because we screwed it up so badly operationally, at least with the original Basel Committee proposals, there wouldn't have been any change. A year wouldn't have made that much difference because you'd still have 90% of the thing weighing on you. And also, Peter makes this point very effectively as well, the way it's done now, if you can't affect your op risk, what are your options besides raising capital if you don't have a big buffer? It's to cut down on market or lending activity. And that seems poorly specified, right? I mean, you should be able to dial down the risk, as you can with market risk and credit risk. You should be able to dial it down sort of internal to the risk phenomenon, as opposed to having to borrow, as it were, the capital from some other area. So I think that while the Basel Committee is making a lot of changes in their proposal even now, and it's going to be, the banks won't dislike it as much because even though it's conceptually the same thing, the amount required is going to be less. But I think there's a good case to be made for rethinking it. Here's the problem. The problem is if you don't do it based on past experience, how do you do it? You do it, we say, well, we want to be prospective about it. Who's doing the prospective? You don't have, you can't say, okay, we've got a lot of historical experience, so we think second liens pose this kind of risk. How do you do that with unusual events like floods and massive lawsuits? Well, then, is it the firm's discretion or is it the supervisor's discretion? Now, Peter actually leans more in the direction of supervisory discretion, which might reflect his experience as CEO of a UK bank, where that's much more accepted. The Bank of it used to be the FSA guys. The Bank of England guys come in and say, well, I think you should do about that. And it's kind of like, okay, a discussion. The U.S., that rankles people a little bit, that the supervisor, the New York Fed team would come in to Citi and after a couple of weeks say, okay, here's your op risk number. And, the Citi guys look and say, where the heck did that come from? So if you don't do it retrospectively, and it's something that's really quite hard to model prospectively, credit card fraud you can model, but a lot of this other stuff it's hard to model. Prospectively, then you're going to need discretion in there. And I think either of those approaches has some real issues associated with it. But I think the real answer to your question is some of the banks that are talking about it now just want capital. They're going for any way they can to get capital requirements reduced. The thoughtful guys are actually going more at the methodology, saying, let's make sure that this is actually aligning with our risks and providing the proper incentives.
Is there one question on this side?
Same question.
Same question. Okay.
You guys read the
Okay,
Wall
there's one
Street
back.
Journal, right? That's where you get that question?
They covered it in a couple of financial press, I think Financial Times and the Wall Street Journal.
How about you go back to the other side? Okay.
You touched a little bit on shadow banking earlier, and I was wondering what your thoughts are going forward. How that particular not sector, but like how shadow banking should be regulated, and who, if it were to be regulated, who would be the primary regulators for that? Like any insights or thoughts that you could share would be appreciated.
Well, so I mean, that's kind of the problem, is that, shadow banking doesn't define a business model. It's basically a description of, depending on who's using the term, it's a description of financial intermediation that looks a little bit like banking, in that you're taking money from one group and doing some maturity and amount transformation and pushing it out to other groups. But that can come in many different forms, right? Money market funds, they were considered a big part of the shadow banking system. SIVs were part of the shadow banking system. You could say that, the non-bank mortgage companies are part of the shadow banking system. They're really quite different phenomena or models. And so that has driven both us in the US and the Financial Stability Board, to date at least, to kind of going through the various manifestations of shadow banking or market-based finance one by one, and saying, do we need to do something here? Or is this kind of okay? Now, of course, a bunch of them disappeared after the crisis, so you don't have to worry about those, at least for the present. What I was suggesting earlier is the problem going forward in the US is that there's no, the Fed doesn't have the authority, and I'm not saying it should necessarily, I'm just saying no one has the authority to say, okay, here's the new phenomenon, the new manifestation of this the new avatar of this of financial intermediation, which may give rise to some problems, so someone should regulate it. And if you think about it, who within our system of government do we want to give more authority to the Fed, which already has monetary policy and supervisory policy and fair amount of sway over the payment system? That seems, some people would say that's aggregating a lot of power. Central bankers always think, oh, yeah, we could do it better, but it is aggregating a lot of authority and power in one place. Do you want to do it in sort of a FSOC committee-like fashion and give the FSOC more authority? Well, you could do it that way. I'm here to tell you it's a clunky way to make policy, particularly if you end up relying on its implementation by some of the member groups. So the issue, I think, is as much one of political economy as it is of economics or finance. And that may be harder in some respects to solve than just saying, okay, once you see the phenomenon, can you make a judgment of it? So I'd be a bit surprised, to tell you the truth, if anybody got more authority in this area over the course of the next few years at least. And so whether you end up having more authority will probably depend on whether some bad stuff happens and somebody says, whoops, maybe we need somebody to have some authority. Where it goes, I don't know. And I don't think we can do the way the Bank of England has done it, which is pretty interesting, or the Parliament. It's pretty interesting. What they do is they have 3 members, the governor of the Bank of England and 2 of the deputy governors are on the Monetary Policy Committee. They're on the board for the oversight of the PSA, the Prudential Supervisory Authority, and they're also on what's called the Financial Policy Committee, which actually does have some macroprudential powers over potentially shadow banking. But the other members of those committees are separate people. So in theory, the governor and the 2 deputy governors are a minority on each of the committees, but they provide a sort of a vehicle for coordinating among those different actors. How that, again, it's more of a parliamentary-driven system, but how that plays out, I think, will probably inform how we and others try to structure something in the future as well.
Okay, let's do one more, and then we should let people go because some of them are probably heading to class.
So you mentioned the operational risk piece and how that's complicated. and how banks would really prefer to have lower capital requirements if possible.
banks.
Some banks.
By the way, I'm sorry to interrupt, but this is a really important point. There are some bankers, including some banks that have very high capital requirements, that will say things privately, will say things like, yeah, you know, some of the regs you guys do, they're just pain in the neck. You don't quite understand how we do stuff. But, basically, we think it's a good thing that you've put this stuff in place because we think we're pretty good at risk management and we know we're going to keep our capital high, but we live in a neighborhood. And no matter how good our sprinkler system is, if the triple-decker next door is on fire, it's probably going to affect us. Other banks just, you know, they basically say, we have an invulnerable, our buildings are made completely of non-carcinogenic asbestos. And there is no way problems, and in fact, we will be stronger because all those people next door who live next door, as their houses are on fire, they'll come running into our non-carcinogenic asbestos house. And so it's yeah, you think if you project what bankers want, lower interest so they can make more, lower capital so they can make more money and all that. But there really are distinctions among how bankers think about these things, which are not unimportant. But go ahead.
So that's a perfect thing to follow on. So late last year, Neil Kashkari was very outspoken about the idea of increasing capital requirements by a significant ratio they are now, and then kind of simplifying some of the more nuanced regulation on that side. Do you have any view on the effectiveness of pulling on that lever, and do you think it could get any kind of traction in the next coming years?
I mean, that number that the Minneapolis Fed came up with was basically our number, but they said it all had to be common equity rather than some of it be convertible debt. You know, there's a, my own view is that a modest additional increase in the capital requirements for the 8 systemically important firms is well advised. I don't actually think for the regional, even the big regionals, that we need more capital there now. The 8 systemically important ones really are a distinct group, and there's a reason why they've been designated. This is not, by the way, you should be clear about this. This is not like, you know, there's this pretty smooth distribution, and we kind of made an arbitrary cut. There is a big gap in the systemic importance of PNC and USB and Cap 1 relative to any of those 8 institutions. Now, Boney and State Street, their systemic importance is not because of the size of the balance sheet, it's because of what they do. But it is not, even though, you know, a couple of those other banks are like scraping $400 billion in assets, and you say, well, you know, that's not that far away from Morgan Stanley. There's just a big difference because of the business models. So I think that when I talked about what's core, core is paying attention to that, to the guys with runnable funding, to the guys whose idiosyncratic failure could threaten the whole system. And as important as PNC's lending is for credit intermediation in most of the eastern United States now, and that's why we'd like them to go through the stress test and show that they're strong, they're in a different league. And so it's there that I think some further increase is warranted. And, you know, if you can find some way to simplify the other stuff and make them happy with the stress test so that they don't have to have a day where they may have a qualitative object, sure, do all that. But, you know, as I said in this public talk I gave here last week, if there's one thing I can leave with all of you, it is capital may be an incomplete mode of regulating large financial firms, but it is at the center of it. And it is a supple tool that, precisely because if the bank is not as leveraged, it has the capacity to absorb losses even if neither the bank nor the regulator was any good at predicting where the losses came from.
That's a really nice closing point. All right, please join me very much in thanking Dan Tarullo.